Welcome back friends to the class number 71. In the previous video, I have explained to you the different features like a fund-based facility, non-fund-based, revolving, non-revolving, working capital purpose, non-working capital purpose, long-term, short-term. I have tried to assign these features to different set of working capital facilities, right? So keeping that in mind, now I am trying to explain one another concept to you, that is of main limit and sublimits. What is this concept? So suppose the main limit is also called your parent limit, and the sublimit is within your overall parent limit. Now what do I mean by this? Suppose you have been sanctioned, you have been allowed the cash credit facility of rupees 100. You have been allowed cash credit facility of rupees 100. That means the bank is ready to take loan exposure up to rupees 100 on you, right? So suppose your business demands that you want LC facility also, you want some packing credit facility also, but bank doesn't want to give you anything more than rupees 100, right? So they want to restrict yourself rupees 100, but at the same time you want to use different types of facilities while remaining within the overall exposure of rupees 100. So in order to allow you this, the concepts of main limit and sublimit come into the picture. So you suppose you want to use letter of credit, bank guarantee facility, but bank doesn't want to take more than 100 rupees exposure on you. So how bank can allow you multiple facilities within that 100 rupees exposure? So they can allow you a sublimits of this 100 rupees cash credit. So suppose your cash credit is rupees 100, then bank allow you 100% interchangeability between LC and bank guarantee. So LC shall be sanctioned as sublimit of cash credit limit. Bank guarantee will be sanctioned as sublimit of cash credit limit. Remember, one cannot sanction sublimit of sublimit. We cannot say that bank guarantee is sublimit of rupee of LC limit. The sublimits are always created out of main limits only. Here your main limit is cash credit, so your sublimit both BG and LC shall be of cash credit only. BG cannot be sublimit of LC. You cannot write that in sanction letter. If you are writing, then it is practically incorrect. So they have become kind of fully interchangeable. So suppose you want to use 50 rupees in LC, 40 rupees in bank guarantee, right? So then you can use maximum 10 rupees in CC limit, because the bank's system cannot allow you to use beyond 100 rupees total exposure. 50 plus 40 plus 10. So you can make any type of permutation and combination within this. You can use LC 0, you can use BZ as 20 rupees. So then you can be allowed to use CC up to 80 rupees, right? So remaining within that 100 rupees exposure, you will be allowed to avail multiple type of facilities, right? So if a client use LC of rupees 10 and BG of rupees 20, then he can't use CC of more than rupees 70. The bank's system will keep that in control. So the overall debt cannot exceed rupees 100 in any scenario, right? So it is a very useful tool used by the bankers. So it is very useful tool for a MSME, for the entrepreneurs as well, because they can use multiple types of facilities as per the requirements of their business, right? So one or two pointers that I need you to understand: the derivative limits that we have discussed in the previous videos, like forward cover, interest rate swaps, currency swaps, these derivative limits cannot be given as sublimits. You have to take them as separate exposure only, separate sanction only. They cannot be given as sublimit of any facility, right? So remember, always remember this. And the second thing is, non-revolving facility cannot be sublimit of a revolving facility. You cannot say that machinery term loan is rupees 100 and cash credit of rupees 50 is sublimit of machinery term loan. You cannot do this. Or vice versa also. See, a machinery term loan cannot be sublimit of cash credit limit. So revolving facilities cannot be sublimits of non-revolving facilities, because there is a high core difference in both of these, the features of these facilities, right? So 1 point, derivative cannot be sublimit. Second point, non-revolving cannot be sublimit. Third point, the sublimit cannot be made of a sublimit. It always has to be sublimit of a main facility only. And the fourth point that we will discuss in later part of our series, that non-fund based facilities are also not allowed as complete interchangeable with fund based limits. So here in this example, the CC is rupees 100 and your both non-fund based facilities are allowed as 100% interchangeable with CC limit. This doesn't happen practically because there is some restriction by RBI also that fund based limits need to be some portion of the non-fund based limit, sorry, need to be some portion of the fund based limit, not totally 100% interchangeable. So if the 100% interchangeability is given, then it may happen that client may not at all use the cash credit limit and he uses 100% non-fund based facilities only, and thereby the bank's exposure will be totally on non-fund based limit, which is not practically allowed to take standalone exposure on non-fund based limit. So there has to be some fund based limit in it, and to do this, bank will restrict some non-fund based facilities. Suppose the bank will restrict LC to rupees 80, BG of rupees 60. The bank will say that you cannot use BG more than rupees 60 remaining while remaining within the total 100 rupees exposure. You cannot use LC more than rupees 80 while remaining within the 100 rupees exposure, right? So bank will put some kind of restriction in order to make a mandate on you that you use some part of CC limit also mandatorily, right? So here this example is again incorrect because the one can use LC of rupees 40 rupees and BG of rupees 60 rupees, then both of these can be used up to 100 rupees. So there is also a gap here which cannot be allowed by the banks, but I hope you have understood what I am trying to explain to you, right? So now from the next lecture, we will be starting reading about the different type of working capital products, starting with overdraft, then cash credit, then so on. So stay tuned with this channel. Thank you very much.